What's up guys, Jake here, welcome back to the channel. In today's video, we're going to talk about potentially what is the most popular form of options trading, and that is selling covered calls. In the event you haven't seen my previous videos on options trading, I will include the playlist down below so you can familiarize yourself with the terms and concepts. And in my videos, I always talk about if you're bullish, if you think a stock price is going up, you can buy a call or you can sell a put. And if you're bearish, you think a stock is going down, you can sell a call or buy a put. However, that is an oversimplification. In this video, we're talking about selling covered calls, and you don't necessarily have to be bearish on a stock to sell a covered call. The reason why is because if you're selling a covered call, then you own the stock and you're comfortable selling it. You're comfortable having it called away. So selling a covered call is actually a great way to exit a position. Why would you just sell a stock for free when you can collect a premium and have somebody pay you money to sell your stock at the price you want to sell it at anyways? That, in a nutshell, is why covered calls are so great. So let's run through the basics of what you need to know for a covered call. And the first thing is you need to have 100 shares of the stock. Now, this can be limiting for certain stocks like Amazon, which is $3,000 a share. You would then need like $300,000 worth of Amazon stock in order to sell a covered call. But for a stock that is only $20 a share or $50 a share, it's much more reasonable that you could have 100 shares of this stock. And since you are the owner of the stock, the 100 shares, you are eligible to write a contract. So you're going to sell to open a call contract on the 100 shares that you have in your brokerage account. And the third thing you need to know is you can actually sell covered calls in retirement accounts. If you have a traditional or Roth IRA, maybe you have tens or hundreds of thousands of dollars in there over your lifetime. When you own the stock, there's really no risk on the exchange. So your brokerage company more than likely does allow you to sell covered calls in your IRA. And I'm going to walk you through in this video with examples why it is, but you cannot lose money selling covered calls. If you lost money selling covered calls, then potentially you sold a covered call that was in the money already below your cost basis. But if you just take some precautionary steps, you should be money with this strategy. And when selling covered calls, there are only two possible outcomes. The first one is the stock does not go above your strike price. In this scenario, the contract expires worthless out of the money. You get to keep your 100 shares, but you also get to keep the premium that the buyer of the call contract paid you. That is your money to keep forever. The second outcome is that the share price does go above the strike price that you chose by the expiration date that you chose. In this event, you're going to have to sell your stock for the agreed upon price, and your 100 shares will be called away. The buyer of the call contract is now going to be in possession of them. They paid you the agreed upon strike price for your shares. However, you still get to keep the premium. So as long as you chose a strike price above your cost basis for buying the stock, you made money. So think about it. Option 1, you made money. Option 2, you still made money. So let's do an example to illustrate covered calls, and let's say that you owned 100 shares of Verizon. You bought it today, the share price is currently $56. 56 times 100 is $5,600. And Verizon is a good stock to sell covered calls on because it mostly trades sideways. So look at the share price over the last 5 years, and it's just kind of hovering in this 45 to 60 range. People like these kinds of dividend stocks because they hold their value and they pay a decent dividend. The current dividend yield on Verizon is 4.48%. Now, if you want to just buy a dividend stock and collect that 4.48%, it's better than, most government bonds or high interest savings accounts right now. However, with selling covered calls, you can make a little bit more money. Here is the stock graph for Verizon, and the share price has been over the last 6 months between the $54 and $62 range. But let's say you pull the trigger and you buy 100 shares of Verizon stock today for $56 a share. Your cost basis is $5,600. Now on your broker, you need to look at an option chain in order to see what the prices are for call contracts. I'm choosing the expiration date of April 9th. This is 34 days in the future. In my opinion, the sweet spot for selling covered calls is 1 month out. And if you don't want to see the puts, you can go to the drop down and you can look at just the calls. So what you're looking at here is the strike prices on the left. So the share price is currently $56, which means the strike price at 56 is exactly at the money. It doesn't really happen that often. Below that, it's shaded in blue. This is in the money. Above 56 is out of the money. And the bidders, we'll just look at the strike price at 56. The buyers are bidding $120 for the premium of the contract. You multiply it by $100, it's costing $120 to buy this call contract. And the sellers are asking $148 or $148. The last price is $130, so you can kind of just assume that that's probably what you would get for selling this covered call with a strike price of 56. Now, where does this number come from? How do they calculate $130 for the call contract with a strike price of 56? And the price is made up of intrinsic value and extrinsic value. Intrinsic value is the difference between the strike price and the current share price. If it's 56, the intrinsic value is 0. There is none yet. So the rest of it is extrinsic value. This is time value, theta decay, and implied volatility, IV. So when you sell a covered call over a 30-day period, this extrinsic value is slowly going to waste away, and the call contract, unless the share price moves to capture intrinsic value, the call contract will expire worthless. Now, when deciding which strike price you want to choose for your covered call, you might want to reference delta. And delta serves two purposes. It shows you how much an option will move given a $1 move in share price. And it also gives you a rough estimate of the probability of the contract expiring in the money. So delta is always a value between 0% and 100%. So on your broker, whoever it is, try and figure out where they show you the Greeks for these option contracts. And for the strike price of 56, it's showing us that the delta is 0.48, roughly meaning there's a 48% probability that this contract will expire in the money and you'll lose your 100 shares of stock. So my advice to you is that when selling covered calls, choose a delta value closer to about 30%. Meaning 70% of the time the contract won't expire in the money, it won't be exercised, you won't lose your 100 shares, and only 30% of the time potentially it will be called away. However, once again, you're always still collecting that premium. So using our example of Verizon, I like the strike price of $58. It's giving us a delta of 26%. So there's a 26% roughly that this contract will expire in the money and we'll lose our shares. But there's a 74% chance that it'll expire worthless out of the money and we'll just get to collect the premium. So the bid-ask spread is between 50 and 59. So let's go over here, strike price of 58. The last agreed upon price for a contract was 55 cents multiplied by 100. You can make $55 off of selling this call contract for a 34-day period. So let's assume that you chose the strike price of $58. And remember, you paid $5,600 for the stock today. And this call contract will expire in 34 days. The premium was 55 cents or $55. So your break-even price is always what you were paid on the premium plus the strike price. So if Verizon's share price gets above $58, the contract will be in the money. Your stock will be called away. However, your true break-even price before you lose value is $58.55. So if it stays below $58.5, then you're not losing anything on the exchange overall. However, what if the stock doesn't make it to 58? What if it goes down, trades sideways, or just gets just short of 58? It only gets to 57, 90, 95. Then the contract is worthless, it expires out of the money, it just goes away, you keep the premium, and you keep your 100 shares. So let's think about what you just got on your investment. Remember, you invested $5,600 in Verizon, and you made $55 basically in a 1 month period. We'll just assume 1 month. 55 divided by 56, you just made a 1% return on your investment in 1 month. So if you sold a covered call every month collecting 1%, you'd make 12%, assuming your stock never gets called away. Now, I'm not saying that's that's going to happen to you, but some people it does happen. So think about it. If Verizon is a dividend stock where you're trying to collect 4.48%, if you can sell covered calls with success for 1% a month, 12% plus 4.48 is going to get you 16.48% on holding 100 shares of Verizon per year. Now, once again, the delta value was 26%, so most of the time the contract will expire worthless out of the money, and sometimes your stock will get called away. So what a lot of people do when they sell covered calls is if their stock gets called away, they don't care. They just buy it back, and then they keep selling covered calls. So 16.48% is the best case scenario, but maybe with a delta value of 0.25, you're only getting it 75% of the time, so maybe 9 plus 4, you're getting closer to 12 or 13% a year on Verizon stock by selling covered calls. So let's look at the second outcome of selling covered calls. And let's say your stock goes above the strike price you chose, and you're going to have to sell it for the agreed upon price. Your stock is going to get called away. So let's assume that in 34 days, the stock is going to go up to $60. It's currently at $56. However, it's going to go above the strike price, above our break-even price, and it's going to make it to $60. So what happens in this scenario? So the contract expired in the money. It was exercised by the buyer, and you were paid the strike price. You were paid $58 a share. So your cost basis was $5,600, and you were paid $5,800. You made $200 by selling your stock that you were comfortable selling anyways. Plus, you get the premium of $55. So you were paid $5,855. Your cost basis was $5,600. You just made $255 in a month, which is pretty good on your initial investment of $5,600. But, technically, yeah, the stock appreciated to $60 per share. It's worth $6,000 now. So you do lose value when the stock appreciates and it gets called away. So you lost in value $145, but you're still making $255. This is why covered calls is so sweet. You choose the price that you're comfortable selling at, and then you just start collecting that premium whenever you can. So let me now give you guys some tips on selling covered calls. These truly are the secrets to mastering covered calls. And the first one is you're going to want to mostly sell covered calls on contracts between 1 and 2 months. The reason why is because of theta decay. Extrinsic value remaining on the contract wastes away really fast in the last 30 days. If you want to go into 60, that's fine too. But theta decay is much lower the farther out your contract is. And most of the time, the premium that you'll receive in a 1-month period in aggregate is more than a longer-term contract. So I know that the premium for a 6-month or a 1-year covered call looks pretty good. However, in a 4-month period, if you had sold instead 4 30-day call contracts, you would make more in premium than a single 4-month call contract. The next tip I have for you is to sell covered calls when implied volatility is high. You can check implied volatility with the Greeks with your broker. It's just under IV, and it's a number between 0.01 to 0.99, and it's a percentage. Implied volatility is how volatile has the stock been recently. How much does it jump around? If implied volatility is high, and anything over 40 in my opinion is pretty high, then the premium of the contract will grow by vega per 1%. So what that means is that you're going to get way more money for your covered call when implied volatility is high. And if implied volatility spikes, you can really just sell the covered call, wait for the markets to calm down. When IV decreases, it decreases by vega per 1%. Meaning the value of the call contract will precipitously drop. And if you want to sell to close, buy to close, you can to capture that vega profit. That might be more than you need to know, but basically if you want to check IV, when IV is higher, you're getting a better premium for selling your call contract. When IV is low, that might be a good time to exit your position early if you want. Tip number 3 is to sell calls with a delta of around 30%. We talked about this in the example, but you don't want to sell call contracts with a delta of 0.5 because you're going to lose your stock half the time. Of course, that's up to you. Once again, you can sell covered calls to exit your position. If you just want to get rid of the stock, then selling an at-the-money call contract with a delta of 0.5 will give you a really good chance of selling your stock whenever you chose an expiration date. But in general, delta 0.3 is pretty nice. Tip number 4 is to watch out for ex-dividend dates. If you're holding a dividend stock like Verizon or AT&T, then just check when their quarterly ex-dividend dates are so that you don't miss them. You don't want to probably have a call contract expire the week before or the week after an ex-dividend date. The reason why is because the buyer of the call contract, if the contract is in the money, might exercise it early, like a couple days early, to basically get that 100 shares before the ex-dividend date. And in that scenario, you would miss out on the dividend payment. So when selling covered calls, watch out for those ex-dividend dates. Don't sell covered calls that expire probably within a week before or a week after. And tip number 5 is that when you check your covered calls, it'll show you how much you've made on your cost basis. And the most you can make is 100%. So if you sold a covered call and was paid a $100 premium, at expiration date, if the contract is out of the money, then the value of the contract is $0. You made a 100% return on selling your covered call. So something you might want to consider is that if the stock price moves, if it goes down a lot, and you've already captured more than 70 or 80% of the value of the contract, let's say you sold it for $100, the value of the contract is now only $20. You might want to buy to close it to lock in your profit because the share price can always go back up. So if you've already captured most of the value of your covered call, then exiting your position by buying to close it back locks in your profit forever. You don't have to risk the share price going back up. Additionally, think about it. If you're selling a covered call every month, you can only do roughly 12. However, if you can capture 80% of the value of your covered call in 2 weeks, you then buy to close it, you then sell another covered call for 30 days. If you can capture theta decay and price movements in a shorter period, you can sell more covered calls in a year and keep making more money on your premiums. And there you have it, guys. I hope I demonstrated in this video why covered calls are so amazing and why of the 4 option types, this is the most popular. If you like this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel if you haven't already. And if you have any comments or questions, I know this was a lot if you're new to options, but I'm always willing to help if I can. Let me know down below. Until the next video, take care.